Welcome to the Deep Dive. Today, we're really digging into Sony Group Corporation's Q1 FY 2025 earnings call. This covers the quarter ending June 30th, 2025.
And it wasn't just another routine report, was it?
Not at all. It painted a remarkably positive picture, actually. The market definitely took notice.
Oh yeah, shares responded pretty enthusiastically.
So we're here to unpack the key financials, yes, but also the strategic shifts. What's really going on under the hood.
And what it all means, really, for investors, for anyone watching Sony.
Exactly. So let's start with a quick snapshot. Because Sony, well, they delivered a stellar first quarter.
Stellar is a good word for it. Record high operating income.
Right. Even though revenue slightly missed the consensus estimates, consolidated sales were still up 2% year over year, hitting 2.622 trillion yen.
But the profit story, that's where it gets really interesting. Consolidated operating income just surged. We're talking 36% year over year.
Which is a record, right? 340 billion.
A record, yeah. And net income wasn't far behind, up 23% to 259 billion.
And the cash flow, that looked much healthier too.
Massively healthier. Cash from operations bounced back strongly. 77.3 billion positive compared to, was it negative 126 billion last year?
Wow. Quite the turnaround.
It really points to strength in those key areas. Games and network services, definitely. Yeah. And imaging and sensing solutions, too.
Okay, those are some strong headlines. Let's peel back the layers then. Dive into the segment, starting with games and network services, G&NS. That was a real standout.
Absolutely standout. Sales up 8% year on year, 926.5 billion.
Which is solid growth, but the operating income.
That's the kicker. It soared. Up 127% year over year.
127%.
Yeah, new quarterly record there too, 148 billion. It's just a massive lead in profitability for that segment.
So it's not just about selling more consoles then. PS5 shipments were up, but only slightly.
Only 4%, yeah, to 2.5 million units. But look at the software units sold, climbed 23% to almost 66 million.
Ah, so engagement is the key.
Exactly. User engagement is thriving. Monthly active users, MAUs, hit 123 million. That's up 6%. And total playtime is also up 6%.
So people are playing more, spending more time on the platform.
And spending more money, it seems. Management specifically pointed out live service games.
Like MLB The Show, Destiny 2.
Those, plus Helldivers 2, they contributed over 40% of first-party software revenue this quarter. That's huge for recurring income.
And they still had big single-player releases like Death Stranding 2.
Which did very well critically. Metacritic score of 90. They also mentioned postponing Marathon a bit.
Oh, why is that?
To improve gameplay quality based on feedback. They still expect it this fiscal year, but it shows, a focus on quality for those live service games. Smart long-term play.
Makes sense. Focusing on that engagement really pays off in the profit numbers.
Okay, moving on. What about imaging and sensing, INSS? Also looks strong.
Very strong. Robust growth there. Sales climbed 15% year over year to 38.2 billion.
And that's driven by sensors for phones and cameras. Primarily, yes. More shipments for mobiles, which is seeing a gradual recovery globally, and also for digital cameras. And operating income. That surged 48% to 54.3 billion.
48%. So Sony's strategy of focusing on those larger, higher value sensors is paying off.
It certainly looks that way. Plus, good demand for sensors in consumer cameras, especially video. These sensors are kind of the unsung heroes in a lot of tech.
Yeah, powering those high-end smartphone cameras everyone wants. Okay, what about the music segment?
Music also saw good growth. Sales up 5% to 465.3 billion.
And profits.
Operating income was up 8% in US dollar terms, mostly driven by higher streaming revenue, which is, still the big driver there.
Plus mobile gaming revenue, apparently.
Right, and they're continuing to strategically snap up music catalogs, too, building those assets.
Smart move. Now, Pictures was interesting. Sales were actually down a bit.
Down 3%, yeah, to 327.1 billion. But
operating income shot up 65% increase to 18.7 billion. How did that happen?
It was largely down to increased television production deliveries. They had successes like The Last of Us getting renewed.
Great show.
And K-pop Demon Hunters on Netflix doing really well. Plus, in Japan, that Demon Slayer movie has been a monster hit.
Infinity Castle generating huge box office numbers.
Over 17 billion yen already, yeah. And global distribution is planned. So even with slightly lower sales, the content they are delivering is highly profitable.
Okay, so a mixed bag on the top line for Pictures, but strong profits. What about the segments that struggled a bit more? Electronics, products and solutions, EPNS, that's TVs, audio.
Yeah, ETNS faced some challenges. Sales decreased 11% to $534.3 billion.
And operating income took a bigger hit.
Down 33%, to $43.1 billion. Main reasons were lower TV unit sales and Forex impacts.
In competition.
Management specifically mentioned aggressive competitor pricing in TVs. So it's a tough market there. Definitely a segment to watch.
Right. And lastly, financial services.
Adjusted net income was up slightly, $23 billion. The big news there is the partial spinoff.
Ah, yes, the listing on the Tokyo Stock Exchange. That's still on track.
Progressing smoothly, they said. Aiming for late September, final application due August 8th. They're also setting up a $100 billion share buyback.
Good for shareholders. But they did revise the forecast down slightly for financial services.
They did, yeah. Full-year adjusted net income forecast down 9% to $98 billion, mainly due to revised interest rate assumptions and some extra risk adjustments. So spinoffs happening, but a slight tweak to expectations for what remains.
Okay, so with that strong overall start, how's the full-year outlook shaping up? Sony seems pretty confident.
They definitely do. They bumped up their full-year operating income forecast by 4%.
To $1.33 trillion.
That's right. And net income forecast also up 4% to $970 billion. Interestingly, they kept the sales guidance the same at $11.7 trillion.
And the tariff situation, that seems to be improving too.
Significantly improving, actually. The estimated hit to operating income from U.S. tariffs is now pegged at around $70 billion.
Down from $100 billion before.
Exactly. A $30 billion improvement. And that's largely thanks to getting their supply chain diversification sorted out.
So moving production around.
Pretty much completed by the end of Q1, they said. It really de-risks things for them, potentially helps margins down the line, though they do expect more tariff impact from Q2 onwards.
Still, a big positive step. So strategically, we talked about engagement economics in gaming. That seems to be the core focus now.
It really does. Pivoting G&NS away from just hardware cycles towards network services, third-party titles, keeping players engaged and spending within the ecosystem.
And the numbers back that up, right? Network service revenue, spending per user.
All growing strongly. They expect content and service revenue to keep growing steadily, even faster than MAU growth next year.
Okay.
That shows deeper engagement translating to higher spending.
What about partnerships? Anything new there?
Well, they announced that strategic partnership with Bandai Namco.
Right. Co-creating IP, collaborating on anime, manga, video.
And sharing marketing data, creating new experiential entertainment. It's a potentially powerful alliance in the content world.
And Bungie, how's that integration going?
Management said Bungie is shifting into a role which is part of PlayStation Studio. So sounds like deeper integration is underway.
Okay. And finally, the broader economy. Any worries there?
They see the U.S. economy maybe slowing down a bit. Slightly decelerating was the phrase.
But no major crash expected?
Oh, no. They think a rapid deterioration can be avoided. They're watching hardware sales carefully, of course.
But entertainment is usually quite resilient, isn't it?
That's their view. People still want entertainment. Even if the economy softens, it's relatively defensive.
So pulling it all together, Sony's Q1 definitely sent a bullish signal. The market reacted well.
Absolutely. Record profits, raised guidance, better tariff outlook. It really outweighed a slight revenue miss.
It shows that strategy shift towards services and engagement is working.
And don't forget the image sensors. That business is just humming along.
So looking ahead, what are the key things to watch?
Well, the next guidance update in November will be important. Continued strength in G&NS, especially over the holidays. And ongoing demand for premium smartphones helps the sensor business.
And that financial services spinoff in September. That could be a real catalyst.
Could be. Reducing the stake to below 20%, cleaning up the structure. It might lead investors to re-rate the core entertainment and tech business higher. Focuses the narrative.
Okay, fascinating stuff. Now, let's shift gears slightly. Time for our This Is Not Financial Advice segment.
Ah, the wild but plausible trade idea.
Exactly. Given everything we've heard, the pivot to services, the tariff improvements, what's an interesting angle here for the next year or so?
Okay, how about this? The Engagement Engine Alpha Play.
Intriguing name. What's the setup?
The setup is Sony's clear pivot in gaming. It's not just about the console anymore, it's engagement economics. Network services, cost cuts, first-party software revenue that's driving the better outlook.
And the marathon delay shows they're serious about quality and live services.
Right. Plus, you've got the financial services spinoff cleaning up the story, making Sony look more like a pure entertainment and tech play.
Okay, so what's the actual trade?
The trade is go long SONY, but crucially hedge it. layer on a short position in a basket of traditional hardware-dependent gaming peripheral and accessory makers.
Ah, okay. So betting on Sony's ecosystem, but against companies relying purely on physical add-ons.
Precisely. The thesis is Sony's becoming this engagement engine. MAUs are up, playtime's up, and importantly, spending per user is up. The real value is increasingly digital, recurring.
Less about the initial console sale, more about the ongoing service and software revenue.
Exactly. So if Sony keeps nurturing this digital community, as they plan to, the companies selling the physical controllers, headsets, maybe even disk drives eventually, their fortunes might decouple from Sony's success.
Especially relative to Sony's digital success.
Right. Their business models are tied more to the physical side, which might become less critical overall. The reduced tariff impact helps Sony's hardware margins when they do sell consoles. But the growth engine is digital.
And the outrageous but plausible twist.
The twist is that the market still often obsesses over console unit sales. This trade kind of explicits that potential blind spot.
Betting that the market undervalues the shift to engagement and overvalues the physical hardware cycle.
You got it. It bets on the growing gap between Sony maximizing value from its engaged audience and the ancillary hardware guys who benefit more from the initial install-based boom. As Sony said, content service revenue is growing faster than MAUs.
Meaning the importance of physical attach rates might shrink relative to the digital ecosystem's overall profitability.
That's the idea.
So the expected outcome is alpha.
Hopefully. Alpha generation by capturing Sony's service-led margin expansion, hedging against hardware cycle wobbles, and simultaneously shorting businesses potentially facing declining relevance in this digital-first world.
A fascinating, if slightly contrarian, way to play the Sony story. Okay, wrapping up then. Sony's Q1 FY 2025. Definitely robust.
Strong profitability, driven by games and network services and imaging and sensing solutions. A company executing a clear strategic pivot.
The raised guidance, the better tariff outlook, it all points to management confidence.
That shift to engagement economics in gaming, plus the ongoing strength in image sensors, it really positions Sony well.
So the lingering thought for you, the listener, might be,
yeah, how much more value can Sony unlock here? As they lean even harder into digital experiences, moving further from relying purely on those traditional hardware cycles. Something to think about.
Indeed. Disclaimer, just a reminder, the information provided in this deep dive is for informational purposes only. It does not constitute financial advice.
Always do your own research and consult with a qualified financial advisor before making any investment decisions.
Thank you for tuning into the deep dive.
We appreciate you listening. Join us next time for another look at the latest earnings calls.